Sell an investment for a $100,000 profit, and the Canada Revenue Agency still taxes only $50,000 of that gain. The long-rumored jump to taxing $66,000 never took effect. Most Canadians think the hike already happened, and that single wrong belief is quietly costing them thousands in phantom tax and skipped sales. Stick with me, because the last myth is the one changing the most people's behavior. For a household like the one modeled in the research, believing these myths can realistically cost over $150,000 across an investing lifetime. I read the fine print so you don't have to. That number comes from overestimated tax and money left in cash out of fear, and I'll show you exactly where it leaks. Here's the belief everyone's carrying around. Canada already raised the capital gains inclusion rate from 1/2 to 2/3, so now roughly 67% of every big gain gets taxed. People believe it because the federal government genuinely announced it and the headlines screamed about it for months. So is it real? The truth. Department of Finance Canada deferred that hike from June 2024 to January 2026, and later budget commentary confirms it was never brought into force. So the CRA keeps applying the 50% rate. On a $300,000 gain, believing the 2/3 myth makes you think $200,000 is taxable, when the real figure is $150,000. At a 40% marginal bracket, that's $20,000 of tax that simply doesn't exist. Second myth, Canada has a dedicated flat capital gains tax rate that applies to your profit. It sounds logical. Lots of countries do exactly that, so people assume Canada works the same way. But that's not how the Canadian system is built. Reality. Canada has no separate capital gains rate. According to Wealthsimple's Capital Gains Explainer, a portion of your gain, the inclusion rate, gets added to your regular income and taxed at your normal marginal rate. That inclusion rate is 50% for individuals, meaning half the gain is taxable. Confusing the inclusion rate with the tax rate is how people miscalculate every single sale. Third myth. If you make a $100,000 gain and you're in a 40% bracket, you owe $40,000 in tax. People do this math constantly. Take the full profit, multiply by their rate, and panic at the result. It feels right, which is exactly why it's dangerous. Here's the fix. Only half the gain is included. So a $100,000 gain adds $50,000 to your taxable income. And at 40%, that's $20,000 in tax, not $40,000. Per CRA-aligned calculators, a $200,000 gain has a real tax bill of $40,000, not the $80,000 the myth predicts. That's an overstatement of $40,000 on a single sale. If this is useful, subscribe. The next breakdown is already coming. Fourth myth. It doesn't matter what account your investments are in, sell, and you'll pay capital gains tax either way. Most people never separate their accounts by tax treatment. A gain is a gain, right? That assumption quietly wrecks their strategy. Truth is, account type is everything. Gains realized inside a TFSA aren't taxed on sale at all, and only your non-registered accounts trigger the 50% inclusion rule, per CRA's Schedule 3 instructions. So realizing a gain inside a TFSA can cost you $0, while the same gain in a regular account gets half of it taxed. Before I get to the last myth, the most counterintuitive piece of this, check which of your accounts is registered. Final myth, and the one costing the most, since capital gains feel like they're taxed to death, the safe move is to keep your money in cash and avoid triggering any tax at all. Sarah, our 42-year-old marketing manager, did exactly this, parking $50,000 rather than invest it. Sounds cautious, it's actually the most expensive choice in this whole video. Here's the counterintuitive finish. If Sarah's $50,000 earned 6% a year for 23 years, it could grow to about $196,000. And even after tax on that gain, she'd keep roughly $166,000 using CRA-aligned inclusion rules. By sitting in cash to avoid a tax that only touches half the gain, she risks giving up more than $100,000 of growth. Fear of the tax, not the tax itself, is the real cost. So, the hike was deferred and never came into force. The inclusion rate for individuals is still 50%, and there's no flat capital gains rate. Only half your gain gets added to income at your marginal bracket. Confirm your real taxable gain with a CRA-aligned calculator. Model any planned sale before you fear it, and check whether the gain lives in a registered account where it may be tax-free. Next, I'm breaking down the RRSP versus TFSA withdrawal mistake that quietly cost retirees thousands in clawbacks. If you want to catch that one, subscribe so you don't miss it. Remember, this is general information only, not financial advice. So run your own numbers before you sell.